This is TicToc by Bloomberg. Good afternoon. If you're just joining us now, we're a few minutes away from the closing bell in New York on what a day it is to talk markets. Joining us now is Bloomberg's Abigail Doolittle. So, Abigail, major averages deep in the red. Where do we stand right now?
You're right about that, Claire. This is really a big sell-off we're seeing on this Monday. We have the Dow, S&P 500, and the NASDAQ all down about 1.5% or more. What makes this also interesting is the fact that we're well off the lows. At the lows, the S&P 500 had been down about 2%. The tech-heavy NASDAQ down more than 2.5%. The NASDAQ 100, in fact, had been down 3% on the lows. Now, for both the S&P 500 and the NASDAQ, this is the worst day since February 8th. So if you recall, we had that big volatility in February, 2 weeks of big selling pressure. We're matching that today, although as we head into the close, the selling pressure abating to some degree. Even so, we're still down 1.4% or more for the three major averages, so pretty bearish. And on the one hand, Claire, it feels like it's out of nowhere, but let's recall last week we had each of the major averages down more than 1% on the week, so the sellers are really trying to take control of the near term, all these whipsaws up and down that we've seen since early February.
And Abigail, let's talk about the drags on the index. You kind of alluded to it briefly just now. The big story today, tech sell-off, Facebook, the biggest laggard in the S&P 500. Talk to us a little bit about the theme here today.
Yeah, so it's pretty interesting to see the tech sell-off. Facebook down right now 7%, its worst day since 2012. And behind this is the news of the data breach regarding Cambridge Analytica. This is a political advertising firm that did work for President Trump during the 2016 campaign. And apparently the idea is that they kept data from Facebook users that they should not have kept. They are now saying that that's not true, and they have agreed to a forensic data audit by Facebook. Also interesting about this story is it came out yesterday, so investors have had some while to digest it, but even more so, Facebook has had a chance to digest it. And until mid-afternoon, they really did not come out with anything, but they were probably under great pressure to finally respond. When this news came out yesterday, they probably thought it wasn't going to turn into something that would take Facebook down as much as it is today, and then once seeing the bearish reaction, the fear from investors, talking about having this forensic data audit over at that Cambridge Analytica, and again, that firm has agreed, saying that it's not true. So this is an early inning, and some are saying that there's much more to come. With the reaction of the stock right now, and technically, Claire, this stock is what I would call a broken stock. It's gapped down today, which means that between last Friday's close and today, there's huge black space on a chart that tells you that the buyers were absolutely blindsided. They weren't expecting this at all. The sellers stepping in, stock below the 200-day moving average. That tells you that the sellers are absolutely dominating the buyers. Even the long-term buyers are out of this stock. If below the lows back in February, which I can pull up a chart right now to give that number, but if below that number of, let's see, just pulling it up right now, $167 per share, this stock will be confirmed technically for a move to $137 per share. Basically, all the congestion we've seen more recently will make an equal and opposite reaction down. Should that happen, it would suggest by implication that the information to come out of this forensic data and something, what else is related to it, would probably be bearish.
So a lot of jitters over Facebook today. How much did we see that feed into other tech stocks, into other big tech stocks?
That's a great question, Claire, because the worst sector on the day, not surprisingly, tech, and I'm just pulling up the S&P 500 IMAP here just to take a look at the sectors, and it's worth noting all sectors lower. The best sectors, utilities, down 0.7%, despite the fact that rates are actually about flat to up slightly. That's a defensive sector, still selling off. Tech on the bottom, down 2%, and so we also have names like Apple, Alphabet, Netflix. Netflix is actually a consumer discretionary stock, but just kind of putting it in there. Same thing with Amazon, but also Cisco, IBM. Old school tech also just selling off. So it's an indiscriminate selling from investors wanting to be out of these tech names. So Facebook has really sent a little bit of a risk-off tone for tech names, even though conceivably, to the best of our knowledge at this time, these other companies aren't involved in this anyway. That's not panic, but when you start to have a little bit of contagion from a company-specific issue head into the sector, that just really speaks to jitters. Lots of uncertainty.
And if you're just joining us, this is TicToc by Bloomberg as we cover the closing bell here in New York. Just about 20 seconds away till the close. And Bloomberg's Abigail Doolittle is joining us now over the phone. So Abigail, we talked a little bit about the action in the tech sector, but is there something more, on investors' minds? It's a pretty broad-based sell-off here. It's not just limited to the tech sector. Are you seeing any read-through in any other themes?
That is such a smart question, Claire, because people often want, when there's a big sell-off, such as today, or a big rally on the inverse, they want a reason for it. But often, and I say this from having spent quite a few years on trading desks, the folks on trading desks will talk about it as there's more, a day like today, there's more sellers than buyers. And relative to, and that's, I guess, a longer way of saying, there's just a bearish tone, jitters, and uncertainty. And very tightly wound investors in markets, they don't need a lot to set them off in one way or the other. That could be to the upside or to the downside. Today we're seeing it to the downside. And relative to that tightly wound market situation, over the last month to month and a half, if you look at it on a chart, it actually looks like a coil. From the highs in January to the low in February, it keeps coiling in. Right now the buyers are trying to take control of that. So lots of jitters over the last 6 weeks. And so we could talk about President Trump and Mueller, Russia. We could also talk about the tariffs, the potential trade war. Of course, the Fed, that's a big backdrop. The FOMC does meet later this week. It'll be Jay Powell's first meeting. They're expected to raise, but what will his tone be? And Claire, I just want to turn over to the major averages because we have now closed officially, and we are looking at a down day, but well off the lows. The S&P 500 down 1.4%. Its worst day since February 8th, so in about 6 weeks, again, from that big swing of volatility we had back then. The Dow down about 1.3%, and the NASDAQ down 1.8%. So right now, the week is young, but we are certainly following up last week's bearish activity with some more bearish activity, some extreme bearish activity.
And so one final question, Abigail. You kind of mentioned it. Fed decision later this week. What are investors going to be looking for?
I think that investors will be looking for a number of things. First of all, the expectation is that they will raise rates by 0.25%. So I think that that's, in some way, I'm looking at the WIRP function, or the World Interest Rate Probability function on the Bloomberg. It's 100% likelihood. So that's pretty much baked in to some degree. I guess the shock would be if that didn't happen, which is hard to imagine that would happen, since Jay Powell so far seems to have, many are saying, a little bit more of a hawkish tone. But I think that they're going to be looking for his demeanor, his tone. Will his way of articulating himself will be different from, say, Janet Yellen or Ben Bernanke. Now, you'd have to imagine that he will be very moderate and not be looking to make swings, but, until we know that, we don't know that. So I think investors are really going to want to get to know Jay Powell. And, the big influence, of course, on rates right now is pretty amazing. With this stock sell-off right now, Claire, bonds are lower. That's really pretty interesting because it tells us from across asset class that despite the fact that we have this stock sell-off, it's not a true panic bid because there isn't a flight to safety in terms of bonds. The yen is actually down slightly. Gold is about flat. So relative to the Fed on Wednesday, bonds are holding steady into that. That's probably more of what that's telling, just in terms of also what will the Fed's outlook be. Will they raise? Right now they're expected to raise 3 times this year, including March, I believe. Will there be some indication that it will be more? If that were to be the case, that could be a pressure on stocks. I could make the argument that the Fed meeting on Wednesday is a bigger deal from a macro standpoint than Facebook, just because if we go back to that idea of tightly wound investors, piece of that tightening is certainly the Fed, rising rates, a repricing of risk, making stocks look less attractive, and then you have a risk-off event like Facebook, a trigger, and it can really cause a little bit of a bearish reaction, as we are seeing today, Claire.
And we'll be keeping an eye on that. Thanks so much, Abigail Doolittle, who follows the markets for us here at Bloomberg. You can follow her on Twitter @TheChartress. This is TicToc by Bloomberg. Stay